I'm probably going to regret this, but here is a full episode, unedited, unscripted, live that we do every single Wednesday. It's called Chart Day. We do it in our private community, and I want to share this with you, the YouTube community. Enjoy. Good morning and happy Wednesday, January 21st. It's 9 o'clock a.m. Eastern. I'm your host, Eric, Mr. Fired Up Wealth, and welcome to another installment of Chart Day. If you're new to the community, welcome. There are a couple of you. These are every single Wednesday at 9 o'clock a.m. Eastern. And the goal of these guys is not to be a trader, not to be a swing trader. Had some questions this morning about what are the best stocks for the next 1 year returns. That's not what we're focused on. We're focused on long-term investing. And generally speaking, at least 3 years, unless the story changes, but really 5 and more years. And that's how you're going to capture these secular growth trends and ride them and really maximize profits with paying the least amount of taxes. And it works. And we've proven that it works time and time again. So what we want to do on Chart Day is after you've done your homework, you've already figured out, you've watched the masterclass videos, you figured out your blueprint, you figured out what you want to buy. You look at all the fundamental analysis, 99% is going to be fundamental analysis, right? Quantitative and qualitative analysis that we teach in the masterclass. Once you've done all that, then you come and look at a chart. The technical analysis is the last 1%. Thank you for letting me know that sound and video is good. And that's exactly what Chart Day is. So we have 17 tickers today chosen by community members. We also look at QQQ and SPX. I'm going to kick off with just giving an introduction of what's going on with the markets here. So if you look at the futures currently, we are slightly down. We had the biggest sell-off yesterday since October. I'm going to pull that up really quick here. Let's see if I can find this. So you can see that Tuesday's decline yesterday, the 20th of January, it totally wiped out the 2026 gains so far year to date for the NASDAQ and S&P 500. This is a good thing if you're a long-term investor. You want volatility. Generally speaking, the volatility is short-lived. You buy stuff when it sells off and you profit, just like in April of 2025. So you should be cheering for lower prices, not for new all-time highs, especially in January. This is definitely a marathon and not a sprint. But U.S. stocks got clobbered, it says, in the worst day in 3 months. So this is the worst day since October. S&P was down 2%, Dow was down 1.76%, and NASDAQ was down 2.39% yesterday. Futures are down slightly. And we have Trump speaking at Davos. This is a big deal. Davos, there's a lot of great information there, but he's speaking at Davos as Greenland push tariff threats take center stage. Now, we always try to avoid politics, but geopolitics are primarily what's driving the market movements right now. Gold is at all-time highs. A lot of people are afraid of what's happening, and that's going to make things like gold prices go higher. Now, I think gold is at this point is kind of in a bubble. You're chasing it. You're FOMO chasing it. It's probably not going to end well. But the thing about momentum is the answer is always up until it doesn't. It's going to go higher until it doesn't. It's the same thing with the AI trade and a lot of the momentum names. We're going to look at some of those charts today. Now, Netflix had earnings last night. Revenues are up 18.1% year over year. Overall, it wasn't a bad earnings report. It was about low guidance or weak guidance based on street estimates. So if you look in Discord, I'm always keeping you up to date what's going on. They had 325 million global paid subscribers. Now this is a big number, 325 million global paid subscribers for Netflix. I posted some stats here and some kind of highlights, a summary of the earnings report, try to keep you up to date. But it really came down to the reason it's selling off. You had a beat on the top and bottom lines. It wasn't a major beat. Plus, you have guidance a little bit lower than consensus. So if you look at Q1 2026 revenue, 12.16 billion versus 12.17 billion. Excuse me. And EPS 76 cents versus 81 cents consensus, which is significantly lower, 5 cents. Enough to make the stock sell off this morning. And if you look at where it's at right now, it's down about 7.37%, 6.6% now. I want to remind you guys that if you're a newer investor or if you're somebody that's a trader trying to convert to, from the dark side to the the Jedi team, I want to remind you that if you're DCA battling, every bagger stock that I've ever owned was red at one point. Rocket Lab was red at one point. Palantir was red. In fact, Palantir at one point, my cost basis was 950. It got in the sixes. So you're talking about the stock being down like 50%, 40%. If I look at Nvidia, at one point I was red on Nvidia. If I can go on and on and on. But I would say pretty much every bagger stock that I own currently that's up 200%, 300%, 400%, 500%, 5,000%. You get the idea. At one point, they were red in my portfolio. It's not uncommon to be down 10%, sometimes even more, after creating a new growth position in a growth portfolio and you're doing a DCA battle. Most recently, you can remember even like MongoDB. That was a buy 225 or less DCA, and it got to like what, 150? So some of the positions in the community might have been down 25%, and they're still up. If you look at it now, they're still up a couple 100% from there, and you trimmed at higher prices. So the moral of the story here is that, we always do our best to be perfect and perfect DCA entries. And that's the whole point of Fired Up Wealth, technical analysis, lot allocation strategy that we teach in the masterclass. And really what Chart Day is an extension of the masterclass. If you're not in that, you're really missing out on what we're trying to accomplish here. And I apologize because that still is not going away. My voice is still not 100%. But if I'm down 5 or 10% on a new position, that's business as usual. And if that doesn't make sense to you, it's likely because you're a new investor or you're a trader, again, trying to convert for the dark side. Read this thread. It was a good question, and I like questions like this. It was 4 a.m. I've been up since 4 o'clock a.m. because I started answering this string of questions, but I encourage you guys to read it because I spent a lot of time really trying to pour my heart into this answer and really be as truthful as I can. I want people to read this, and I want people to think very hard about what it's saying. One of the hardest things that I can do is converting traders into investors. It's very easy to see those shiny objects, the get rich quick schemes, the social media that's misleading most of the time. Nothing worth doing is easy. If you want true, sustainable, generational long-term wealth, it's long-term investing. There's not a single person that I know that has wealth from trading. It just doesn't work that way. The first thing you need to do is watch the masterclass videos, take them seriously, watch them from start to finish without stopping. Don't watch on a phone, watch it on TV, watch it on a computer screen. Don't listen, but watch, take notes, and treat these like college classes. You're going to get so much more out of it. And that's really what you need to do to get on the level that you need to be to get the most out of this community. Because otherwise you don't understand what we're trying to accomplish. And I get it. People come in and they're like, well, I've been investing 5 years, so I know everything. No, you don't. Well, I can't remember the exact stat that I gave out, but I think I said, if you've been investing less than 5 years, you're really still like a rookie. Now, you have a lot more experience than somebody that just started, but you're not an expert. I've been investing almost 30 years, and I don't consider myself an expert. I'm still learning every day. But we have this overconfidence effect that, this overconfidence bias that I've already got it all figured out. I don't need your help. I've been doing this 5 years and I've been making money. I'm not going to learn anything from watching your videos and listening to you. You're wrong. And I encourage you to try to keep an open mind. It's a new year, new horizons. So Netflix, I think there's a decent chance that you see that stock. If you look at the S3 Fibonacci, it's at 79.87 down here. Could it break $80? I think that's kind of the area to watch. I did buy some, at $80.97 or something pre-market. There's a chance it breaks sometimes you break that Fibonacci and it goes to like something like 75. And if you really want to get specific here, you can go down to like 67 on the trend. The way I look at this stock is, I'll look at it and say, here's my DCA area and it could go anywhere in here. And I'm going to buy levels. I'm going to do my best Sometimes you start buying here and it only gets to here and it rockets up. That's a high quality problem. And we have stocks like that, like AppLovin, where you don't fill position. Sometimes, maybe you think that the floor is something like 85 and sometimes it goes to 75. And in that case, you're going to be down 5, 10, maybe even more percent. And that's okay. Because think about it, at some point, this stock's going to go back to 100, 125, 135. If you're buying it at $81 a share, even if it's down a little bit, even if you have a $90 cost basis, when it's $134, you're not going to be complaining. And you're also not going to remember, you're not going to look back and say, man, I remember, 2 years ago, I bought Netflix when it was 90. I wish I would have just waited. The exact bottom was $81. I should have just waited to buy at 81. You will absolutely drive yourself insane if you think that way, because every single thing you do in investing is not going to be perfect. There is no such thing as perfection. All you can do is dollar cost average the best you possibly can. Do the best you possibly can. What it's about is building a blueprint and finding companies that ride secular growth trends that are best of breed that you can invest in for the long haul and maximize gains. A chart's never going to tell you any of that. The majority of your effort and research should lie in that fundamental analysis. That qualitative and quantitative analysis, again, is 99%. But looking at some of these numbers for Netflix, overall, it's pretty solid. It's just that guidance. You can look at some of these charts and these patterns here. You got to be smart. Tom Green. If you look at revenue, everything is trending the right direction overall. You do see some of that earnings growth accelerating from 9.5% Q1 2025 all the way doubling to 18%. That's the direction we want to go. Now, the big opportunity, the number one risk for Netflix is going to be penetration, saturation. If you already have 325 million globally, and so it's 325 million subscribers globally, right? And then I was interested about the largest subscription service in the US, and that's Amazon Prime. And that leads with 180 to 201 million members. Of course, that outpaces Netflix at about 81 million for US. So 81 million for Netflix, 200 million roughly for Amazon. But if you're smart and you understand that there's only 135,000 households in the United States, you're going to look at that and say, well, that doesn't, or not 140, this is in thousands. So if you look at this number, you're going to understand that this is in thousands, so millions, right? But you're going to understand, like, if it's 134,790 in thousands here, this doesn't make sense, right? Because you're talking about 200 million subscribers and you got 134 million households. And so the reason for that is because Amazon Prime memberships are counted as individual user shoppers. And so oftentimes people have more under a household, basically have multiple people per household. So like I've got one account, one membership, but I use it. My wife uses it. I have 2 kids that use it. There's 4 people and it counts all 4 of those under that larger number. Anyway, just in case you're interested in some of those metrics. So there is some room for growth for Netflix, but you're still at 81 million US subscribers. If you have 135 million households, rough estimate off of Fred there, the problem with that is a lot of people share passwords and things like that, and you're never going to have full penetration. You're not going to have every single household that's going to have a Netflix subscription. So a lot of that growth relies on international, and a lot of that growth is going to rely on advertising, right? So Netflix it's not like a slam dunk. It's, if you look at the stock, right? If you bought it back here in 2022 for 12 cents, you're up 72,440%. But those, those exponential gains are long gone. But you can see this is a parabolic ride up and a nice pullback, and you see what happened last time that happened. You got to $69, it pulled back to 19. So it could go a little bit lower. If you look at overall trajectory of this, if you're trying to match it, maybe it goes a little bit lower. Maybe it goes to $70, $75. But then it's going to probably make another run up. And this is what we're trying to capture. Do our best in this range and capture this run up. That's what we're trying to accomplish with Netflix. And I think that will happen with some time. Is 18%, off the charts? Is it a hyper growth stock? No, it's very much a mature growth company. It's between growth and mature growth. 18% is not bad, but it's not, A Lab with 135%. So understand what you're buying. Now we are in earnings season. And so we kicked off this week with, a lot of the banks the last couple of weeks and things like that. Today is the first. So last week we started with the banks. Taiwan Semiconductor, which crushed it. It showed you the AI trade is still alive. You got Netflix last night. You also had yesterday, 3M and US Bank Corp, some of these, Johnson & Johnson this morning. Intel is going to be tomorrow. Procter & Gamble, Alcoa. Starts to get interesting next week. We got Microsoft, Tesla, ASML, IBM, Apple, Tractor Supply Company, NASDAQ, SoFi. And then we get the following week here, we get into early February. We've got AMD and Chipotle and Alphabet and ARM and T-Mobile. So a lot of these mega cap tech kind of Super Bowl of earnings is going to be in this period here. So between the volatility and the geopolitics and the Davos speeches that we're having right now, and then having Microsoft and Tesla and Apple earnings next week, understand that you could see some volatility, and I tell you to have some cash because opportunities are going to come. Here's an opportunity right here. Netflix at $81, in my opinion, is an opportunity. I thought it was an opportunity even higher. And I always DCA and I battle, and sometimes you're really good and you perfect it and it works out great. And other times, it's going to go a little bit lower than maybe you're hoping it will. And that's okay. And the thing about Netflix is I have about 2.9%, I think, after this morning's buy in the community portfolio. I'm happy to go to something like 4%. So it's perfect. If it wants to get down to 70, 75, we'll basically back in and run out of room. And hopefully at that point, then it turns the other direction and boom, you have a great cost basis and you're set up really well as a long-term investment. It's just very hard as a new investor or a trader to change that mindset of like, I'm buying something as it's going down and I'm really thinking long-term. I'm not trying to just, sniper time the bottom and scalp $1 and make some quick profit. That's not what we're trying to do here. It's very different and you need to really change your mindset. Okay, so after 17 minutes of talking through the markets, hopefully it was helpful to get you up to speed with everything. Let's now dive into chart day. We always start with S&P 500, SPX. If you see yellow, that's today's chart day. Orange is the previous chart day. You can see right now we're at 67.96 on yesterday's close. If you look at the S&P 500, 66.30 to 67.17 is possible on the downside. So that's going to be something like 66.30. We just 66.30 is about right here. And we're going to go up to 67.17. And that's about right there. So that little circle there is a possibility. This could happen on the downside. We're here right now. You could see something here. And of course, it always go lower because the 200-day simple moving average is sitting here at, 63.51. But bullish support was 68.23, and we lost that yesterday. That means you could see more downside. Now, when you lose support, you could have a little bit lower, and it could just snap right back. And if you get some bullish headlines, you could snap right back, and you could be at all-time highs. I think at some point you're going to see 7,000 and beyond in 2026. But we're in January. And you want volatility. You want this to come down to the 200-day moving average because you want to buy this. Just like the opportunity we had last year where it dropped in April, you're probably not going to get something as sweet as this. But even if you get a third of that, it's an opportunity, right? For the people that are saying, hey, I wish I could have bought that. And I wish I would have done that. Woulda, coulda, shoulda, this and that. No FOMO. Be patient. Don't chase air pockets. Opportunities come. And it might not be the broader index. It might be an individual stock like a Netflix or a ServiceNow or whatever it is. But opportunities will always arise. There's always something to buy. You just have to know where to look. And you have to know how to build a blueprint that really fits your needs so you can make it all work together. QQQ is the next thing we look at. This is the NASDAQ 100 ETF. Now, this does have 604 support. And in pre-market, we're actually green now. So I mean, it's an interesting market right now. This is showing flat. S&P is showing up 0.11%. Volatility means exactly this. Stocks are going to thrash around. That's what volatility is about. But according to this, we're slightly up in the pre-market. If you can see this. So this is showing you pre-market 609 over here, 24. So it's showing you that's up $1. It's hard to say. I want the market to sell off. I want like 200-day moving average on the QQQ at 564 because I want to buy more. I've got $500,000 in cash and I want to buy something. If it doesn't happen, that's okay. I'm gonna always figure out something to buy. Right now, I'm periodically dollar cost averaging in the dividend portfolio, buying things like FDVV and SCHD ETFs. I've also been buying IBM. I've been buying some Tractor Supply Company. I've been buying some T-Mobile, some Qualcomm. There's always something to buy, guys. So that's where we're at, and overall, we're still leading bullish actually on tech. The more people that hate the US and want to sell their US stocks, well, you could see more volatility. So we'll see what happens with what Trump says. And, macro definitely matters. It's an important part of investing. And it's why I always do live streams every Monday, Wednesday, and Friday to keep you posted with what the hell's going on. The first stock today, chosen by community members, is going to be CrowdStrike from Randall. Randall in Thailand. How you doing, Randall? CrowdStrike S3 427. You could see 395 to 407 on further downside. So right now in pre-market, we're slightly green. With anything, it can bottom anytime. If positive news happens, or say even next week, you get to earnings and you get a smash report by some of the mega cap tech names, the market decides to go bullish again. Names like CrowdStrike can turn around and go to $600. I think you'll see it at $600 later this year. But if you said like, hey, this thing's going to sell off to 350, would I be surprised? No. This is a SaaS name. What do I tell you about SaaS names? I tell you that most should avoid it or treat it as spec. And that includes CrowdStrike. Even though I have high conviction on it, you can't borrow my conviction. And expect crazy things with these. If you're, looking at CrowdStrike, my cost basis is like $100, $108. I've been in the stock since 2019. I've added along the way. Do I like the stock? Yeah. It's below the 200-day moving average. You still have an S3 down here at 427. Would I be a buyer here? Probably not, but it depends on your blueprint. If it's something that is a core position, periodically dollar cost average, buy it every paycheck till you fill out your 3% or 5% or whatever you want. From a technical level, it's a hell of a lot better than almost $600 a share. And this is why we trim. A lot of it's psychological, but it just helps, especially with newer investors. You buy a stock at 300 and it goes to 550 and you trim some out and you're at house shares and it drops to 442. The psychology is mostly removed from the equation. Everything I do, everything I teach is about putting guardrails in place so you don't drive your car off the cliff. The reality is if this stock keeps doing what I think it's going to do, you could buy it at 440, you could buy it at 550 and you still make money in 3 to 5 years, which is our time frame. But do you have the psychological grit and fortitude required to ride that beta? Most don't. TKO is the next stock. TKO, technical knockout, Mike Tyson's punch out. Running hard like a lot of stocks. You can go look at this back in November 2023. It was $71. Going even back to 2021, it was $44. Boom shakalaka 218. It's a pretty parabolic chart, but not straight up, kind of a healthy, just a healthy grind upwards, right? Overall. So it has pulled back. It was at the 50. It bounced off the 50-day simple moving average. That's the yellow line there. Downside, you got your S3. So your fib range is 177, which is this number here. And then your R3 up here on the top, the Fibonacci is 234. So you got 177. So this is 177, right? And this is 234. 234. And so if the stock is somewhere in the middle at 203, you have roughly a little bit more upside than downside when you look at risk reward. But it's kind of like a 50-50 ball. I generally want to have, 2 to 3 or 3 to 4, meaning you want this, much larger than this. And it's hard to find those in this kind of market. Now, I'd love to look at Netflix with you guys because I know a lot of you buying it. And I know a lot of you buying it just because I'm buying it. I am confident we'll make money on it, but understand it's not Rocket Lab either. You're not going to get a 2,500% on Netflix or on ServiceNow or on anything that we're buying right now, Rubrik. It's just that's not what it is, right? So if I look at this stock at $82, which I think is a buy at these prices, can it go lower? Sure. Let's just use 75 as our floor. And it could always go lower than 75. Just because I draw a line on a chart doesn't mean it can't go higher or lower than that. Now here's your previous high. So let's just say previous highs. Now the reality is I think that you're probably going to have support at $80, but I'm going to pretend like that's not true and I'm going to say it's 75. So now this line is $75 and this line is $134 roughly. You see how the green is bigger than the red, right? So we want to get this ratio where it's like something like a 3-to-1. You know, even a 2-to-1 is okay, but if I can get like a 3-to-1 where, you know, it's like this is 3 times larger, you know what I'm saying? Like if you have 4 parts, it's 3/4 of that is going to be green and 1/4 of it's red, kind of a thing. This is decent risk reward. When the stock is, you know, up here, it's not decent risk reward. And you wouldn't have all the same numbers, but like, let's just say when the stock was here and it falls. So it's at 134 and it falls down to 117. Well, I still have downside all the way down here. And the upside is just kind of back to that 134, which is even a stretch. You know, that's not good risk reward setup. But now the stock is down here. And I wasn't doing that right earlier, as you guys probably were yelling at your computer. So let me just do this. Let me just do this one more time. All right, let's go. Here's 75. That's what happens when you get up at 4 o'clock. So I wasn't doing that right earlier because I didn't move this line down. So it's actually a lot better than what I was showing you. So this is where it was yesterday, and this is where it is today. Okay, so does that help now? Because even before it was good, but now it's really good. And now let's even get more conservative and let's say, okay, well, maybe it goes all the way down to this trend line. You know, so like here's your trend line roughly, right? Even if it goes down to the trend line, if I'm buying it at $81 this morning, my risk is only that. And that's like unlikely that it's going to get to $65. It could happen though. So this is like using worst case scenario and you still have this tiny red and this huge green. These are the kind of opportunities that you want to focus on. Not as as a trader too, if you're trading, but this is a long-term investment saying, hey, if I hold this stock, it might take a year or two. It might take two years. It might take more, but this is going to be $150. And if I'm holding it for 3, 4, 5 years, I'm going to double my money, over that period. And that's what we're looking for. It's always great when you can find the rocket labs that give you 2,500%. That's not what Netflix is. That's why you have a basket of different types of stocks, because those spec stocks can give you those massive returns, but they also have greater risk on the downside. But hopefully that visual helps when we talk about risk reward, because here's where the stock is trading. This is your red and this is your green. That's significant positive risk reward where I want to be buying stocks. Now, when I first started buying the stock, your support was actually quite a bit higher. Let me just delete that. When I first started buying this stock, the 134 number was the same. But if I looked at the fibs back then, they probably went to like $90. And so you're buying it, say you're buying it at 95. This is what the risk reward looked like. Now, of course, that changed because it went quite a bit lower on these fibs. But both of them are really good setups if I'm trying to be a long-term investor saying, and this is just a visual. 134 is it's the all-time high. That's why we're using it. Anyways, back on track. So TKO, let me just make sure I have closure on that one for you. You know, this is kind of a 50-50 ball. It's not generally where I like to buy, but can it go higher? Sure. The R3 is 234, but to me, it's like, it's really depends on your blueprint. Again, are you buying this as a fringe play? Well, a 50-50 ball risk isn't what I want to buy. Is it a core position where I really want to have 5% and I want to own it for 5 or 10 years? Well, now I just periodically dollar cost average and the chart doesn't matter that much. That's why you really have to understand what the blueprint is, because if you don't have the blueprint, then you can't make any of these decisions. And I can't make the decision for you. Market just opened. This is a derivative, just be careful with that kind of stuff. It's not something we can cover. And I realize that, and we didn't give you any warning or anything because it's not breaking the rules necessarily. I mean, if I made a true list, there'd be 10 more things on that, but I'm trying to make that list as simple as I can. Even like this is not something I generally want to cover, but it doesn't break the rules. And I can cover this. It's the last one's a derivative type of ETF. I really just want to avoid that in the community. If you want to buy it, do whatever you want, but it's a derivative swap. And that's really a trading instrument. It's not something you buy and hold. So it's not something we should discuss. Now, this is a little bit better, but the problem with this is it's an ADR and it's OTC, over the counter. So this is not trading on the New York Stock Exchange or on the NASDAQ. And you can see these candles, how they're kind of weird looking. It means there's low volume. And this is really just not that helpful as a chart. What it can tell you is that it's below the current S3. There is a previous S3 of 21. The chart really doesn't help that much, other than to say, well, it was 40 and now it's 22 and it's a lot better here than it was there. Booking BKNG. I'm surprised they haven't done a stock split on this, because you're talking about a $5,000 stock. It got up to almost 6,000 at 5,800. This is mild consolidation. You can see some nice green here. So people coming in and buying. This was November. We got down to 45.62 and then rocketed to 55.20. You could see a similar type thing here, where it comes down, rockets up, comes down. This is a 50% consolidation, and you could see new highs. It's possible. I would be careful with a lot of these, Expedia and Booking Holdings and stuff, because if the market starts to slow down, the consumer starts to slow down, these names get hit. They're very cyclical. And when I look at stuff like this, I always ask people, why do you want me to talk about Booking Holdings? Now, I'm not saying it's a bad company, but if you build a blueprint and you say, this is my all-star team, this is my fantasy roster, I've picked the best secular growth trends. I'm talking about AI. I'm talking about, quantum computing and space and all these things that I think are going to be big trends over the next 5-10 years, robotics, autonomous vehicles. And you say, I built out my fantasy roster. So I'm using all these secular trends, cybersecurity, this and this and this. My first question is, does travel even make a secular trend? And in my blueprint, it doesn't. Now, I did buy Expedia and made some good money on that. Admittedly, sold it too soon because it went way up after I sold it. But that was a fringe play. It's not something where it's like, oh, I have to have this because it's part of my blueprint. And so maybe that's your answer. Brendan might say, well, this isn't a core. It's not part of my blueprint necessarily. It's more of a fringe play because I just think it's a really good buy right now because of whatever reason. Maybe that's true. But I encourage you to always look at your guys' blueprints and say, is this a secular trend that I really want to ride? Because if it's not, it doesn't matter. If it is, the answer is yes. I do think this is a secular trend that travel is going to continue to grow. Then you say, what's the best of breed? And this probably fits the bill. This is probably best of breed. So I'll give you that. But does it really fit your blueprint of what you're trying to accomplish? Now, if you're not a super high growth portfolio, maybe that's true. Maybe it does fit in there. If I'm going for growth, 8 out of 10 community portfolio, I don't know. I think the company will be worth more later. But I encourage you, and this is always about you, what does your blueprint say? 9 times out of 10, because I think this is a newer member, they probably don't have a blueprint and they're just looking at stocks because it could be a Peter Lynch thing. Like, hey, I use Booking Holdings all the time. I booked my honeymoon through it. I want to own the stock. That's totally fine. There's nothing wrong with that. But I really encourage you guys to build your blueprints. So this had mild consolidation. I'd like to see it lower, but right now it's green. It's very, very green, and it's going higher. And you can see it's got upside to probably 56.48 here on this. And then up in the top R3, we're talking about 58.94 new all-time highs. It'd probably get resistance around that 5800 where it previously kind of topped out. Next is Hood. Now, when I say this, don't be offended. It's just a fact. I own Palantir, I own Tesla, I own SoFi. These are meme stocks. Hood is a meme stock. All right. Not saying the fundamentals haven't improved, not saying it's not a good company, not saying that you can't invest in it, not saying you can't make money in it. The reason that it's important to understand that is because this is very momentum driven. And so a meme stock, or you can call it a momentum stock, a called stock, a retail, you can call it whatever you want, whatever makes you feel better. But understand that these type of names, whatever you want to call these, they're very difficult to gauge. They don't play by the rules, and they can do crazy shit. This stock could go from 106 to 173, and I wouldn't be surprised. You could go down to the trend and it could be $36. Literally, if you went into a recessionary type period, if this stock went under $50, it would not shock me at all. Literally lose 50% from where it's at. If you also said we're going to be in a bull market by the end of this year, it's going to be $175, that wouldn't surprise me either. So again, is this part of your blueprint? Because that's going to help you to figure out how you're going to buy it. This was in an air pocket. It has consolidated. It was 150, 153. It's pulled back. More than likely, it got down close to the 200-day moving average. More than likely, it goes higher, and it goes back to 150 again if the bull market remains. Bull market doesn't remain, it can lose half its value. So do you have if you have a blueprint and you say, here's my blueprint, and I really think that these trends are going to win me a ton of money over the years. They're going to make me a ton of money. And one of those is fintech and, retail investors being degens. That's a secular trend, which probably is. It's probably a great thing to invest in, actually, because that's not going away. You say Hood, it's something I'm going to own for a decade. Unless the story changes, I'm literally just going to buy and hold this. I'm going to monitor. I'm going to listen to earnings reports. But this thing's going to make me a shitload of money. This thing's going to be $500 in 5 or 10 years. And so I'm going to buy it at $100. And if it falls to 50, I'm going to be excited because I'm just going to buy more and double down. If you have that mindset, you can buy whenever you want. The problem is most people don't have that mindset. You don't have the conviction. You haven't done the homework. You haven't done this work on the front end. You just come to me and say, and I'm not saying you specifically, Cal, but people come to me and say, Eric, I want to buy a stock to where I can make 50% real quick, Hey, give me a list of your top 3 stocks that are going to do well over the next 1 or 2 years because I'm trying to simplify the process without making it a full-time job. I'm not picking on you, but come on. It's going to take a little effort. You got to decide what you want to invest in. This is your money. You can't borrow my conviction. So if you have conviction in this bad boy, buy it at $107 because, if it's going to do what you think it's going to do and be $500, it's going to go higher. And if it goes down and crashes, you're going to be stoked because you want to buy more. But if you can't see yourself being stoked if it's $50 a share, well, then maybe you shouldn't buy it. And go back to the drawing board, go back to that blueprint, go back to research. 99%, right? And even before you get that 99% fundamentals, there's a ton of time required, even before the blueprint. And this is why the masterclass is so important. Why are you investing in the first place? To make money? No. What's your why? I don't know. I want to have more money later. No. What's your why? Okay. Well, I want to have my kids have a better life. I'd like to be financially independent by 55. I'm always going to keep working, but I want to have the flexibility. Maybe I'll be a consultant. Okay, great. How old are you? 35. Okay, you got 20 years. What's the number? What number do you think you're going to need? Well, I've ran some scenarios, some what if scenarios, ran some math, and I think, I need $5 million based on a 4% yield, $200,000 in passive income. That's my number. Okay, great. Easy. Plug it into the interest calculator. Let's do it together. This is stuff we do in the masterclass, but if I need to convince some of you to sign up for it, hopefully this helps. All right. So review for a lot of you pros, but say, Eric, I got 20 years and need $5 million. This is all my why. I haven't even got to the blueprint or if I should buy hood or any of that shit. Okay, great. How much money you got? I just started last year. I got $10,000. Sweet. That's a great starting point. Hopefully you have most of that in ETFs. All right. How much you put in a month? Well, I'm young and I am putting in $1,000 a month. Hopefully I get that, number higher. And I understand that some of you, that number might be $100 a month or 200. I started with 50. Let's just use 1,000. A lot of people here are investing somewhere between 500 and 5,000 a month. I know it's a big range, but that's the numbers. You got 20 years. Time is on your side. That's the number one asset that you can't buy it. And we want to be conservative, maybe 10, maybe 12%. If you want to be really conservative, use like 10%. Now I hope you crush it, and I hope you get 20% annualized returns. You can't use that. So let's just say 10% conservative. Where am I going to be at? Well, I'm not even going to be close because in 20 years, I only have $754,000. And you can say, oh, well, and this is what people do. They say, well, last year I got 30% returns. I can do that every year. So I'll just do it like I did last year, and I got $10 million in 20 years. Yeah, that's probably not going to work out for you. But, if you get 15%, well, now you got a 1.3, you're getting closer. But you can see that you're going to have to somehow invest more money. And so now if you're investing 5,000, you say, well, I'll never get to 5,000. Well, you'd be surprised. But this is your number. If you got $10,000, you need to shoot for $5,000 at a 12% rate for 20 years to have $5 million. Now, most people probably aren't looking for 5 million. That their number might be something like 2 million. Well, now it's a little bit easier, right? Now we say $2,000. Boom. We'll go 2,200. Does that get us there? Roughly, right? So roughly $2 million. That's at 12%, 20 years, putting 2,200 a month. Now you only start with 10,000. Some of you got $100,000 portfolio. Some of you have, $500,000 portfolio. Well, that's going to change the game. If you got 100,000, they always say that's the hardest, right? The hardest, that first 100,000. You got 100,000, you're saving 1,000 a month. Now you're getting close to that $2 million number. That's why you really want to get to that first 100,000. It makes it easier. But the whole point of this, reason I'm doing this exercise is, what is your why? Why? Why are you investing? Why? Why do you want to learn how to be an investor? Why do you want to spend your time to educate yourself to be one of the best investors on planet Earth? Because you want a better financial future, but what is your why? You need specific, vivid goals that you write down. Now, once I have this why and I know how much money I need, that's when I can start thinking about, okay, what are the secular trends? What's my blueprint going to look like? Because I know I have a 20-year horizon, and now I can be a little bit more aggressive. And maybe that means I can have 10% spec in my portfolio. Maybe I'll even go a little bit more aggressive and go 9 out of 10 risk. And I'm going to do something like 12% spec. And now I can start putting the pieces of the puzzle together because I have my why. If I don't have my why, I can't do anything. And then you build the blueprint and you get to that and you say, hood is something I really want to buy. Well, if you really want to buy it and it's 5% of your blueprint and you want it to be a core, well, the answer is periodically buy dollar cost average, be buying it today. But I can't do all that work for you. And I know that a lot of you come in here for the wrong reasons and you say, I just want to do chart day because I want to know what stock to buy to make money quick. I get it. We've all been there. I was in your shoes once. You have to convert from the dark side to the Jedis. That is where true success is. And you're not going to experience true success in general, sustainable generational wealth is not going to happen unless you learn how to be a long-term investor. And you're in the right place if you want to learn, if you want to rally yourself around successful people. This is what the community is. Birds of a feather flock together, and you are in the right place. Next is Broadcom, AVGO, start a position. Here's the thing with Broadcom. You're going to have big cap earnings. You're going to have even Broadcom earnings not too far away. Earnings are going to be really critical for all of these and for the AI trade as a whole. If mega cap tech comes out and says we're going to cut capex, well, a stock like Broadcom is going to get slaughtered. I don't think that's going to happen. I think it's going to be a decent earnings. I think capex is expanding. In fact, they're building a data center 2 miles from here, from Gemini. It's between residential neighborhoods, which is absolutely batshit crazy. And it's going to increase my electric bill by 9% and my water bill by about 10% starting this year. And they're already kicking that off. And that thing literally is a square mile. That's how big that effing thing is. It's absolutely insane. And they have, there's projections right now to build another 20 data centers in this area. 20. So anybody that thinks that AI is in a bubble, they're on a lot of heavy drugs. And that's just true. So Michael Burry, you're on drugs. And maybe it works out for you because of macro risks and stuff, but the fundamentals are there and this shit is going to go higher. Does that mean it can't crash and go down to 267 S3 on, in the short term? Yeah, it absolutely could do that. The cool thing about this is I've been teaching you guys the right way to buy. And so you already own stocks like this much lower if you've been with us. Now I can understand the frustration if you're a new investor, because you say, well, I wasn't in Fired Up Wealth over the last 3 years. I've been crushing it with 225% gains in the community portfolio. I get it. So where should you buy? With this yellow circle, which has actually been there for quite some time. Stock was up here at like $400. And I said, here's the area I'd probably DCA. It's a big range. You're getting close to that. You're at the top of that range now. But that 200-day moving average is about 299. Could you have some kind of earnings slip up or something and come down to 267? Absolutely. You're still in an air pocket. The trend line here is 218. But again, is this a core position? Have you done your work in the front end? Is this part of your core of your blueprint? Well, then buy it. Periodically buy it every paycheck. You don't need Fired Up Wealth technical analysis, lot allocation strategy in that case. All right. Until you get it up to a decent size, right? You got to build it up. You got to start somewhere. If you got a new portfolio, you got to remember you're putting money in every month and you're moving the needle. So if you have that $10,000 account we looked at and you're putting $1,000 a month in, you're moving the needle 10% or whatever every time you put money in every month. If I've got a $3 million main portfolio, I need $30,000 for 1%. 1%, which barely moves the needle. You know what I'm saying? Like, I need to put in like 100 grand to move the needle, which is not easy to just go to my tree and shake it and get 100 grand quick. It changes the game, which is why I have 3 portfolios. Now that community portfolio, we started at 0 in 2022 and the thing's pushing like 400K now. It's nuts. You can do it too. We just showed you how to do it. And yeah, of course we did it in 2022 and it was a bear market. I get it. I can't change time for you. I wish I could go back in time, but there will be another one. You just have to be patient. It will come. It's just a matter of when. The market is a constant cycle, a constant pattern, and you'll get those opportunities again. If you think you can just disappear though and wait for that opportunity to come, you'll never, ever, ever capture that opportunity. People think they can do it, and I've never seen it done in 30 years. So say like, hey, the market's higher. I think your community is great. I'm just going to step away. I don't have time. I'm busy and I don't have the time to allocate to learn this stuff. And, I'll come back to it later. No, you won't. And if you're broke now, you're going to be broke later. You have to decide that this is what you want to do and you have to put the effort into it. The ones that do, you can look at all sorts of examples. I mean, look at like a Derek, how much money he's accumulated in the stock market in such a short time. And it's not like he's putting $5,000 a month in his account either. It's just picking the right stocks and having the right mindset and knowing how to buy and rallying yourself around a solid community like this. When you get to that scary market and it's full, fear of losing everything, if you don't have a support group, you're not going to buy anyway. People say, I'll wait for it to go lower. It goes lower. I'll wait for it to go a little bit lower. It goes a little bit lower. I'll wait for it to go a little bit lower. I'll buy Netflix when it gets to 75. Well, then, good chance it doesn't get to 75. And when it's 150, you're like, man, I remember when it was like $80 and I was going to buy it and I didn't, Don't be that guy. Don't be that gal. You're not going to be perfect. Just constantly buy and use some intelligence when you buy and you're going to make money. Like this. This is a stock that you might want to buy. Now, I don't know anything about the fundamentals necessarily because I haven't researched the company, but let's just assume that you've done the fundamental work and you're like, the fundamentals are rock solid. Well, shit, man. I mean, what's the bottom? You can see that this stock, Vital Farms, has come down to this 27 to 30 range, and it loves coming in here. And what does it do? It bounces up and comes back. It's a yo-yo stock. It's a trader's stock, and people love to trade this kind of shit. But let's just pretend like the bottom falls out, and we can just take, let's take, so this is $10 and this is $30. So let's split the difference at 20. So let's say that that's $20 right there. And that's the lowest that we think it'll go, that orange line. And now I don't use just this technique to buy. Understand, this is like one tool in a tool belt of thousands, right? This is mostly for visuals. If this stock is trading right now, here, and this is the worst case scenario, and this is getting pretty ugly because it's literally cutting half of its value from where it's at, which is unlikely. Okay. Now, just to get to this red line, that's pretty good risk reward. But you can see that it loves to come down and yo-yo off of 27 to 30 and then bounce up to 45. There's a good chance it does something like it similar again. And it could be a little bit lower, it could be a little bit under, a little higher, but give or take. You've got two general channels here. And there's a decent chance that you're going to see it come up in that channel again. And so if this is my downside at $20 a share and it goes back to 45 and the stock's trading here, this is pretty damn good risk reward. This is good and this is bad. Not rocket science. So this is what I mean by, understand what you want to buy, do the homework on the front end, build a blueprint, find quality companies that are best of breed. Now I would question again, like, is this a secular trend that you really want to own? Why do you want to buy Vital Farms that, sells eggs? I don't know. I guess because eggs are always gonna be around. I'm not saying it's bad or you can't invest in it, but just ask yourself, does it really fit what I'm trying to accomplish? If it does, great. From a technical level, this looks pretty good. In fact, if I were momentum trading, which, I did back in the day, this might be something I would have even tried to buy in the S3 and kind of, swing trade it or something. I'm not saying that you should do that. But this is a pretty good technical setup is what I'm telling you. Whew, all right. SE, Harbinger. I can pronounce your name finally after 5 years. C limited could bounce here, although a decent possibility that you get 107 to 112, because if it's below 137, that's kind of your resistance level. So it needs to break 137 for bullish upside momentum. The S3 is 108.55 down here. Yellow circles are from previous chart days. And I said these are DCA areas and you're in these yellow circles. This is probably where I'd buy if I didn't already own it at much lower prices. This is a good pick. It's a good one to show because this is air pocket. No, don't FOMO chase. Don't buy air pockets. Air pockets collapse. You're below the moving averages. You're even below the trend line. It's not much of a trend line, but it's a trend line. This is where I want to buy stocks. Not here. But not just because the chart looks like that, but because I've done my homework. I know my why. Why do I want to invest in the first place? I know my goals. I have a blueprint, right? Goals and blueprint. And I've decided that C Limited is a great stock to own, best of breed for international e-commerce. And I think e-commerce is going to be a huge secular trend. And I want it to be 10% of my portfolio. And this is going to be 3%, along with 3% Mercado Libre, and the other 4% is going to be Amazon. Hypothetical. So now I've already done all that, but it's like, hey, I look at the chart and I'm like, damn, this thing's ripped. I got to wait for a pullback. I'm not buying 193. I got it on my watch list. Shit gets down to 120. I start DCAing. I know I can go lower. S3 108. Boom. This is how you do it. This is how you successfully buy as long-term investors and maximize your profits. This is a great example. Now, I'm not saying it can't go lower, and the fundamentals are going to tell you that. If the fundamentals are deteriorating, well, the stock's going to deteriorate with it, and now it could be a $70 stock. And this thing has gone through some stuff. You can see it's had a nasty sell-off from 2021, and it didn't do anything for quite some time, but it's had a really nice snapback since then, and the fundamentals have improved significantly. MongoDB in the place to be. So one of our favorite tier two, our phase two AI, Gen AI, has to deal with data, right? It's ontology data, connecting the enterprise data to LLMs, making use of it, right? With Palantir and Snowflake, 225 or less DCA. And I remember, some of you guys, so this came down. I mean, this was a DCA battle and some people struggled. And I got messages like, what do I do? My God, why did I buy? I have 10%. Like, just why'd you buy it? Because I thought it was going to go higher. Okay. Well, then you shouldn't have bought it, but let's talk through it. Do you have a blueprint? No. Well, do that. Okay. Come back to me. I made a blueprint and MongoDB made it. Well, did it make it because you have the bias because you already own it, or did it make it because it truly would have made it? Well, a little of both. Okay. Well, here's the deal with it. I thought it was to buy 225 or less DCA, and it went a hell of a lot lower than I thought it would. It went to 140. But I had the conviction to keep buying it until I got to a certain point and just said, I don't think I bought any 140. My last shares might have been 170. And you could have been a hero and waited and just sniper time that, but good luck. But if you did buy 225 or less DCA and you end up getting something like 190, maybe a 200, even a $200 cost basis, when it ripped up to $400, you just doubled your money in a very short amount of time. And that's where I want to be buying it. I don't really want to buy MongoDB at 383 because I know what this stock does. It's another yo-yo name that literally, it does this. It goes from 590, and this is where I trimmed the first time. It went down to all the way to 137. And you can see trim. This is where I bought it the second time. Then it ripped up and I trimmed again at 500. And then it came down and I bought pretty aggressively in both portfolios in this price. Now I am waiting to trim because I do think you're going to see that $500 level. And that R3 right there is 513. And you can see it got to 570, 509, it's going to get back, in my opinion, to $500 if the bull thesis remains intact and it's considered one of those AI winners. If some kind of narrative changes and all of a sudden Dan Ives starts talking shit about it and the market changes, well, the stock could go back down to $150 a share. That's how these work. And what do I always tell you? Most should avoid SaaS. In this case, it's not SaaS, it's consumption based, but it's still cloud. Most should avoid SaaS or cloud or treat it as spec. So if you're buying this stock, it shouldn't be 5% of your portfolio. And if it is, that's fine. It's your money. It's on you. But understand that's not what I'm trying to teach. So your question, Bain, is, I don't know. Maybe you want to buy it. Maybe you want to trim it. It's at the 50-day moving average. And the thing is it could consolidate and go back to $500, or the thing could drop. The 200-day moving average is 278. So earnings are going to be really important. Earnings for this stock are... Did they just happen? That must be wrong. Here. March, they're not until March, so you got some time. But I think it gets to $500 in a bull market in 26, but it's overvalued. It's not worth $439 a share. It just isn't. It's crazy how some stocks get tagged as AI winners and they hold up like this and they do this kind of thing. And then others just keep falling, like ServiceNow. And it's like ServiceNow comes out and says, hey, we're going to partner with OpenAI and ChatGPT, and the stock still doesn't really do much. It went up $1 or $2 today. It just, sentiment is crazy. And you have to respect it. And I said it in the write-up. If you haven't read this, I think it's good. Not only does it cover ServiceNow, but it also covers the 8 must-own stocks. Now, I want to talk about this for a second. On that list of 8, it doesn't have like CRM or Palo Alto. There's a couple other names that I like. These might not be as high of conviction, but it doesn't mean I don't like the stock. It's not like an all-inclusive list. Those are the 8 that kind of come to mind that really stand out as ones that would benefit. But go check that out because it talks about the kind of the top software stocks. You really want to focus on cybersecurity, right? Data or agentic AI, or a combination of the 3. If you're in software, that's where you want to be. In ServiceNow, I believe, will be a winner on that agentic AI front. But at the same time, if you read the write-up, this is not a super high conviction stock either. This is not in the same category as CrowdStrike or something like that, right? Um, Oracle is next. Oracle, I've been telling you guys to be patient. Now it's getting close. It's teasing me. It's 177. What did I tell you guys? 175. Be patient. Still confident it's going to happen. And maybe it's one of those things that gets to 176 and it doesn't make it quite there. But 175 or less DCA is really what I'm looking for on Oracle. And it did get to 175.05. And guess what, guys? My limit order was 17497. So I missed that by 8 cents. And that happens sometimes. You know, is it the end of the world, $2 more? No. And that's not the message I'm trying to teach. It's only 1%. So there's a chance maybe I come back and I do buy it at 177 or something later today. But I did have a limit order at 174.97. The point though, even if you buy it at 177, there were a lot of people in Discord that were going bat crazy at like 195. And I said, hey, it's fine if you want to buy it. And again, if it does what you think it might do, it's probably worth a lot more than $195 in 5 years and it won't matter. But in the short term, there's a good chance it goes down to 175. And if you bought it at 200, now you're complaining because you're down 12%. It's a psychology thing, right? Again, guardrails so you don't drive off the cliff. I showed you yesterday in my watch list. If you don't pay attention to this channel, you should. I got you up to speed with a lot of stocks, you know, ServiceNow, or here's Oracle, 186 pre-market, still waiting patiently. The DCA at 175 or less DCA. My cost basis is 140. I want to DCA up. S3, 150.45. I still think 175 is very possible. So where did it get this morning? 175.05. Do I win a cookie or a prize or anything? It literally got to 175. Now, my order is always that 97 thing. So, you know, missed by 3 cents. That's, you know, whatever. That happens. But 175, it's 5 cents from 175. It's technically at 175, but if you're looking at 175.00, it missed by 5 cents. It's pretty good. Pretty good. Good job. So most of the video, I've not touched it. I want to edit this part in though. So the stock did actually dip below 175 and I did fill my limit order. And of course the stock can always go lower later. That wasn't the message. The message though is that I said it was going to go 175 or less and I wanted to DCA at that price level and it did get there. I've looked at thousands of charts. When it was up here, it's like, you know, you probably want to trim it. The reason I didn't trim it is because I have 1.3% of my portfolio and I'd love to have 4 or 5%. So I don't really want to trim at these prices. You could say, well, you could have trimmed here and bought it back. I don't know 100% for sure it's going to happen. I just think it's going to, and there's no reason to pay taxes when I'm going to hold it for 5 years. And again, this is a mindset thing. If you can't shift it, it's very hard. It's very hard to fathom any of these things that I'm telling you if you're still in a trader's mindset. We got to work on that together. But I've been telling you guys 175 and it hit there today. So I think it's a buy. 175 or less DCA. If you pay 177, it's $2, it's 1%, that's fine. Could it still go lower? Absolutely. The S3 right now is 150.45, as I said. Your trend line, though, is about 168, 69. I mean, this is a great DCA area right in there. That's where I would buy it. Not here. And I told most of you to trim it when it got to 350, but I told you not to buy it here. It's probably going to go back to 175. You know, and originally I said 250. So I want to be clear on that. I told you when it was up here that it would go below 250. When it got to 250, because that selling was so violent, I analyzed again. I reanalyzed it and said, okay, yeah, it did get to 250, but now I think it's going to go to 175. So that's where we're at. Oh, man. Okay. I'm spilling passion out all over my microphone and I hope you guys appreciate it. Lyft is, does it fit your blueprint? Are you sure? Are you sure? Yeah. You know, autonomous driving, robo-taxis, I think Lyft's gonna be a play. And that's the only answer it could be. Because otherwise it's like, right. Because if robo-taxis are going to be like taking over the world, then your only play would be like that Lyft is going to be a big part of that. And then you have to argue with me that Lyft is the best of breed. And I would say, well, you know, you might argue that Tesla is going to dominate Uber and Lyft, but even if, let's just say Uber and Lyft survive, which is the best of breed between Uber and Lyft? I think most people would tell you Uber. Does it mean you can't buy the stock? No. From a technical level, it's bouncing and it probably goes higher. R3 is 25, and you can see that in bull market. But you're also going to have earnings season, and this earnings is February 10th. And if earnings don't deliver, you can see the stock at $13, $14, $15 a share. Earnings do deliver, it's going to slowly work its way back up. When I say slowly, because it's not going to pop probably from 18 to 25 overnight, but it'll slowly work its way back to 25. So here are your fib ranges right here. $15.72 to 25.16. Risk reward, not too bad. And of course, it can always go lower than the bottom of that, but this is where we're at. That's not too bad. Decent risk reward. But why are you buying in the first place? Does it fit a blueprint? Are you buying as a fringe play? That's fine too. You could say I'm buying as a fringe play. Fringe play is kind of like a fancy fired up wealth swing trade, because a swing trade is usually 12 months or less. And usually it's really like 3 months or less. It's like a couple months, a swing trade. Day trade is literally a day trade. You buy and sell the same day. You never hold any positions overnight because you're a day trader. Swing trader is anything over that that's less than a year, but it can be 3 days, it can be a week, it can be a month, it can be 2 months, it can be 11 months. A fringe play, we often are buying for 1 to 2 years. That's kind of like our version of a swing trade. It's a long-term swing trade. It's still considered a long-term investment once you hold it 12 months. But remember, our goal is 3 years or more, and usually it's 5 years or more. Boom. EMBJ. And if you want to talk about parabolic charts, I mean, here's a great example where the stock goes from like $7 in 2022 and it's just like 74 and it's above everything. It's in its own stratosphere. This R3 is $69. It's parabolic and it's just, woo, what do you want? What do you want to know? Are you looking to trim? Well, anywhere in here, $74, $75, probably a trim area. Would I buy it here? Probably not. Could it go higher? Sure. But this is not where I like to buy stocks. The 200-day moving average is $56. Risk reward. If you do a risk reward with this, say, okay, what's my risk reward? Well, I don't know what the upside is here, but it's probably not much higher. Let's just eyeball it. And let's just say your downside is a 200-day moving average. This is dog shit risk reward. This is not where I want to buy a stock. Does that visual help? Hopefully it does. Zscaler. Zscaler was not worth $336 ever in a million years. It's not worth $300. So this is not rocket science. You buy the stock when it's 175, and if it gets 300, I was trimming it at like 290 and 300. Yeah, it goes higher. That's just the way it is. Is it a buy here? Probably like around $200 a share. Not a bad entry. My preference is 175 or less. So really same as last year. Buy at $175 or less. DCA, trim 300 plus. S3 is 192. Could bottom on S2, which is kind of what it's, let's see. So these updated like literally since last night, and that's okay. Actually, what it is this is the old one. So this is the S3, and it broke through the S3. You can see it went a little bit lower to 205. This is if you're using fired up wealth, technical analysis for allocation strategy, that is your first area to buy. Right here, 208, and here's your second. You're hoping it gets here because you want to add more lower. It might not get there. You might get, your first 50% and it rips up, and that's a high quality position to be in. But I always like saving some room to kind of hedge it in case it doesn't work out, right? It doesn't go up right away. And if you don't do that, it can be really painful. How's this thing holding up? Because I have some orders at 75. Okay, it's not getting there. You can see Netflix, it doesn't mean it can't come back. And this is something, if you haven't experienced these kind of stocks, these kind of charts, you might look at this and say, oh yeah, I bought it this morning at 82 and now it's 84. I'm a genius and there's nothing but up from here. That could happen. But usually what happens is, you get a little bit of chop, some consolidation, and it could kind of hold that overall floor, but it's not just going to usually V-shape unless you have like an April 2025 event. And it could even go higher, like $3, $4 higher, and it could break down and you could even see it 75 later. That could happen, especially if there's a negative catalyst. You've got this whole thing with Warner Brothers Discovery, something can happen with that. But either way, I'm buying it, in these areas. And if it goes lower, I'm buying those areas and I still have room. And I bought some this morning at 81. I think the cost basis on it is, let me just look, because I'm curious. A little bit longer chart day today, but hey, just bought some rubric at 64.77, 5 shares. That just came across. I want to log in on my phone because I want to look at this. So we are up 1.2% right now, and I'm looking for Netflix. I had a bunch of orders in that didn't go through this morning. Hopefully get some more selling later. Netflix right now is, so we have a cost basis on Netflix in the community portfolio of $91.64. So that is down roughly 7%. It's because it's still actually down 2.78% today, even though this is a green candle. This is a nice green candle because what happened is it opened up lower and then it got some buyers. You can see here 81.51. This is roughly the lows of the pre-market. And now it's $84. So you're talking about, the low here is 81.95 at open, and now it's 84.59. Now, if this went to $79 by the end of the day, would you be surprised? No. But right now, buyers are coming in and saying, hey, enough's enough. $80 is a decent price. That momentum could carry on. But you're never trying to guess that. And that's the thing. I really do believe that new investors come in the market and they think that there's a magical way to know that. And you can't know that. Nobody knows that. I don't know that. Anybody that tells you they know that, they're full of shit. They can look at a chart. I can look at this and I can say, it might go here and it might go here based off Fibonacci's. But if you look at this, it didn't get to the S3. So if you're waiting for exactly 79.97, just like I was with Oracle at exactly 174.97, sometimes you miss, which is why you DCA levels. And sometimes it works out better than others. But again, when I opened up in the beginning of the session, I said, hey, a lot of times stocks that I've owned for years that I'm up a lot on, they were down at one point. Next, so did we get through Zscaler? I think you guys got the gist, right? I think it's a DCA area, but I really prefer it 175 or less DCA. Klaviyo is a small position we own in the community portfolio, and it was doing really well, and it just lost everything back. Now this is one of those new IPOs in 23. In theory, you could have just sold the damn thing at 49 and left it alone. It's tough because I scold you guys about does it fit your blueprint? And you say, well, hey, Eric, does Klaviyo fit your blueprint? Actually, no. And neither does like 5 other those small positions we have in the community portfolio, like Four and Marquetta and shit like that. Like I wouldn't put that on a dream roster because I don't like fintech. I buy it because hey, the community likes it, whatever. This is one where we looked at it as undervalued when it was in the 20s and it doubled your money. We're still up on this about 10%. So we've got a pretty good cost basis. And we did trim some of these shares when they were higher. So we're set up pretty well. But the big question, like with all these software names, is another one of these SaaS names. Does AI completely disrupt it? You need to do some homework on it because I think that's possible. This is kind of like it falls in the same category as Twilio, where it easily could be disrupted. I think it could bottom soon. It looks like it's bottoming pretty well from 23. It's already up $2. It's really testing the May 2024 lows. The lowest I see is $21. Didn't quite get there. It got to about $22.91. Party time. All right, Axon. This is one that we were buying, like 550 or less DCA. I was very, very adamant about not paying over 550. It got to 508, got a sweet cost basis. We're still up 17% or so from these late 2025. This is like fall time of 25. So not even that long ago, a few months ago. This is selling off because all SaaS is selling off. And this is, bucketed into SaaS and everything's just getting sold off. If you're looking for moats in SaaS type names, this is not like a true SaaS name. It's a hybrid of hardware with the tasers and the body cams. It's funny because I actually had cops come to my house Sunday night and they had Axon tasers and they had the body cam with the whole cloud unit. So it's like 6:00. We're eating dinner on Sunday night and the cops are knocking on the door. It's -5 degrees outside. We invite them in and they got all their gear and they got their guns. My kids are thinking like, oh, dad's going to jail. So anyway, Axon, I like the stock 550 or less DCA. If you want to pay more, it's going to be on your conviction and blueprint. And you can't borrow that from me. My conviction is that I don't want to pay over 550 a share. And I'm very adamant about that. And there's reasons for that. Go do a search Axon on the Discord. There's lots of information out there. And next is him. Sometimes Sometimes I wonder, like, does anybody even watch this stuff? Like, is anybody watching me right now, or am I literally just talking to this black dot? I hope that somebody out there is watching and getting something from this, because this is important stuff to me, and I really enjoy doing it. Hopefully, a few of you guys like it, right? Hims and hers, it falls again in the meme stock category, and it's got momentum till it doesn't, and then it can get momentum back again. And a couple posts on Reddit, and boom, we're off to the races, and it can go from 29 to 70 again. That's just how these work. Went from 72 to 30. It touched the S2 at 29 area. The S3 is 26.25. Fundamentals first. Does it fit your blueprint? Yeah, GLP drugs, are a secular trend. Okay, then why don't you invest in Lilly? Or, to me, that's best of breed, but maybe you could say NVO, because now it's beaten down, and they've got a one that you can take with oral. Well, Lilly will have one too, whatever. But is it a secular trend? Does it fit your blueprint? And what is it best of breed at? You say, well, specifically not GLP, but home delivery of drugs, because young people prefer this method and they need ED medicine when they're 25, which makes no sense to me, but whatever. That's the commercials tell me. I guess I'm blessed at 47. I don't, probably TMI, but whatever. We're adults, and hey, no one's listening anyway. So I can make jokes to entertain myself at this point at an hour and 20 minutes. But I would argue, like, does Amazon healthcare disrupt this? I don't know. I mean, maybe do some homework on it. Maybe it doesn't. I don't know. Young people will tell me I'm crazy. I'm a boomer. I don't know shit. Hims is the best company in the world. Screw you, old geezer. Okay, fine. I'm a boomer. I don't get it. I'll go make my money in what I understand. And by the way, your other favorite stocks like Rocket Lab and Palantir and Nvidia, yeah, I own those like way, way lower than you did. So I'm not I'm not completely a boomer on every topic. So maybe I am on him. Say healthcare is not my forte. It's okay. I'm also 47 and I don't have any subscriptions. I don't know. This isn't something I know. All right, Hims. This is something I do know, and that's Cloudflare. And I like the company a lot, but the thing is it's not worth $175 a share. Now, with that said, it's going to be $200 to $250 this year. So you say, well, how does that work? You don't think it's a $175 stock, but you're telling me it's going to go to $250, because that's what happens in a bull market. So do I hate the stock at 175? No. If it came down to like 134, more attractive. You are in an air pocket. I don't like to buy air pockets. Now, this did go from 260 to 177. And here's the thing. Again, if you have high conviction, it fits your blueprint, and you want it to be a core, well, then you just periodic dollar cost average, and this chart doesn't matter that much. Now, if you are using the fired up wealth technical analysis lot allocation strategy, it would actually be considered a first area to DCA in here, but I would prefer it much lower, and understand it can go a lot lower. $100 is really what your trend line's at. Your 200-day moving average, though, is here. And more than likely, it's not going to come to trend. It's going to hold up something like a 200-day, and it actually broke that. So if it started to go the other direction, wouldn't be surprised. Now, it's going to have earnings on February 10th. If the stock's at 135, I can say, I told you so. If it goes to 250, I can say, I told you so, because the reality is that I don't know. The chart doesn't tell me what the earnings are going to be. Is the stock expensive? Absolutely. Is it exciting? Does it fit into my blueprint? Yes. And it has since 2019, when I first bought it on the IPO, or 2020, or whatever the hell date it was. 2020. Actually, I bought some in 2019 late, but then when we started the Discord community, it was July of 2020. And that's where I filled out the position, and a lot of you guys bought it. And that is 17 tickers in an hour and 20 minutes. And hey, a few people are replying. So there are actually people watching. That's awesome. And I'm being facetious, because I know that some of you watch this. I'm hoping I can get a few of the people that haven't been with me for 5 years. Like, I see Derek watching, and I'm thinking, that's awesome that Derek's watching. But like, Derek needs this information less than a lot of members, like, especially these new members, right? And Harbinger and Mike and, Dark Horse. These are all great names. And Elizabeth. And if I'm missing somebody, I'm sorry if it's live. I want to see these newbies that are coming in, ask me questions at 4 a.m. And I'm not picking on you again. So please don't hate me. You probably aren't even watching this, right? Because you're not going to get to that point. But the new members ask me, literally tagging me at 4 a.m. I get an alert on my phone, right? So if you tag me at 4 a.m., I'm going to reply. You know why? Because it's going to wake me up. because I have my phone on and I've got the alarm, the buzzer on, and I'm not turning it off. Why? Because if something happens catastrophic, I got to be the guy that come in and fix it. So if you tag me on a message, whether it's 1 a.m., 2 a.m., 3 a.m., 4 a.m., it doesn't matter. I'm going to get alert. It's going to wake me up and I'm going to reply. So if you don't want to do it, don't tag me. If you do, it's fine. And I will get up and I'll reply to you. I woke up at 4 and did an hour and a half back and forth. But those are the members that have these questions. I truly want to help you. And I want you to be the people that are replying to me right now saying, yeah, I'm still watching an hour and a half in and I'm learning a lot. That's what I want. That's my goal. I've helped some people and I want to help even more, especially these new members that just can't completely grasp what we're trying to accomplish. I could say a lot more and I'm fired up right now. As you guys could probably tell, I'll save a little bit of my voice, probably a YouTube video tomorrow, but honestly, I'm not even 100% sure on that. I might take the day off tomorrow. We'll see. I'll let you guys know. Either way, I'm going to record it for sure. I'm recording on Saturday for the new conference video, and that will come out next week, Saturday. So we just had the space video come out. Lots of great feedback on that. I appreciate it. Today is the 21st of Wednesday. We do have a live stream on Friday, the 23rd. And then this Saturday, the 24th, I'm recording the Quality CEOs video. That will come out the 31st of January on Saturday, that morning. So, and then it's just every other week we're coming out with a new video until we're through all 7 videos. And the 7th one is a Zoom meetup. So there's 6 like high production videos, like the one you just saw, the space video, and then 1 Zoom meetup. Ethan's still here. Good to hear. Good to hear. Good to see it. I appreciate you guys very much. Even after 5 years of doing these every single Wednesday, I try to keep the fire high. I try to keep the flame going. I try to keep that flame burning because I know it helps some of you guys. We're going to make money, guys. There's going to be ebbs and flows of the market. That's just part of it, man. It's, right now I'm looking at the future. I mean, look at this crap. Come on. I want to buy stocks. I don't want this. I mean, I know some of you are happy, like, yay, the market's high. No, I want that. I want the market to tank because I want to buy some stocks. I got cash. I want to buy. And if it doesn't, it's okay. It's a win-win. I've got whatever, $3.9 million or 3.7 or whatever the hell it is in the 3 that are invested in stocks. If the market wants to go up, I'm making money. If it goes lower, I got cash and I can buy it. It's a win-win. I got my cake and eat it too. All right, Greg, good to see your flame. Hope everything's good in the Virgin Islands. It's colder than shit here in the Midwest. Appreciate you guys. Appreciate you being here. Appreciate the support. I feel like we're still just getting started with this whole thing. And I need to harness some of my energy to just keep pushing the envelope and making this better and better every single day. And that's my goal. And I appreciate all the people that are still listening to me that are helping me and helping the community achieve that, because it really takes a team of people. Like one person can't do it all. And we have such amazing members that are willing to constantly comment and answer questions for new members and join live streams and do research and due diligence and post and share and comment. And it's freaking amazing, man. That's why it's the best investing community on the planet. And let's just keep that momentum going here in 2026 and crush it. We have so many more years to invest and learn and grow together. Appreciate you guys. Have a great rest of your day. We'll see you. And Derek's just getting warmed up, he says. Peace.